with the Fed action and with what we saw with the relief bill, are we seeing the credit markets react positively?
Well, yes, Sully. I think, well, it's great to be back and talking with you on unfortunate circumstances, but there's certainly a lot to talk about. I think instead of getting caught up in all of these acronyms, it's probably easier to just explain to the viewers that the top end of the credit structure, the AAA stuff and the IG stuff, the Fed is able to come in and lend against that pretty easily with its mandate. As you get into high yield and you get into CLOs and you get into private label CMBS and non-agency RMBS, these are places that are really, really struggling. And I mean really struggling. Even the top end of those capital structures and the structured credit are seeing some extraordinary moves. So I think what you have to kind of put in perspective is the Fed can do a lot to fix well-functioning and fix balance sheets that are in a pretty good place. But when it comes to things like the energy patch or what we're seeing in the leisure and hotel business, it's going to be really hard for the Fed to do anything there. This is a place where the balance sheets are pretty levered. The guys have, a lot of hair on them, frankly, and a lot of vagaries in how to look at the future. So this is not a place where Fed policy really helps that much. And it really comes back to what your guests were saying earlier about clarity on when people can get back to work. And that's going to be the sort of crux point for the market, if you will. That's where we're going to see defaults. We're going to see ugly stories. We're going to see lots of layoffs. We're going to see lots of problems. But what the Fed has done in the IG market and the investment grade market, phenomenal. And when we saw a great reaction to that this week. I will say, though, I am a little disappointed that we're still sitting right around 2,500 in the S&P when we've basically done QE2 in almost a week. It's kind of depressing, honestly. I would have thought better, and the fact that we haven't gives me a little more pause for caution on the idea that we've got to go down a little more.
You probably have your own data, David, but I saw some data, and I'll get the traders to comment on this when the interview wraps, too, which is EPFR put out $235 billion was put into money market funds in the last week. There was $135 billion put in, I think it was, the week before that. We're talking about $400 to $500 billion effectively going into cash in the last 2 to 3 weeks. Is that the wrong? That's bullish, right? Is that the wrong move, or is that ultimately bullish?
I don't think that's the wrong. I mean, a lot of people are basically liquidating risk assets, and they need to go somewhere. So where are they going to go? They're going to go into the safest place they can go, which is the money funds. And so I think you're seeing people park it there and just get liquid, get cash, and get ready for whatever they're going to do next. And that may be launch into some of these riskier places once they can get some clarity. So I like the idea that we saw massive equity outflows from retail. That's a positive sign. That usually means we're closer to a bottom. I like the idea that a lot of people have gone to cash again, usually closer to a bottom. I do worry, and this, I don't want to get too technical. I do worry a little bit about the risk parity strategies. There was a big article this week about how China cut its allocation of that. And you remember we had that period where both stocks and bonds were going down at the same time last week. And that was really this is really a strategy that has trillions allocated to it. It's sort of people levering up fixed income as a hedge to long risk assets. And if you have rates at 0 or 20 basis points for 2-year notes and 40 basis points for 5-year notes, there's no way to do risk parity anymore. So that money needs to leave and find a new home. So I think we've got a lot of moving parts. But, I'll sum up, because I know you're always pressed for time. The credit story is really a messy one. We've got the top end in the investment grade world really well taken care of. We've got some people without respirators in the more exotic and higher leverage spaces in the credit markets, and they're not going to get them anytime soon.